Hi, this is Michael Joyce with Agili, your personal CFO, and I'm pleased to share with you our thoughts and viewpoints for the winter of 2021. And what a crazy year we had in 2020. I mean, when we started the year 2020, which seems like about 10 years ago, little did we know that we would have a pandemic and then an economic shutdown and then pretty much a full recovery. And where we are right now, where the markets are higher than they've ever been before. And we are still very optimistic about where we are going forward, because we do have vaccines that are on the way, and more about that in a couple minutes. But there's also pent-up demand that will certainly come out, and this pent-up demand will fuel higher economic growth, and as a result of the higher economic growth, we'll probably see some of the trillions of dollars that are sitting on the sidelines come out and get invested, particularly investments that have higher yields. So there's currently nearly $5 trillion sitting in money market accounts, earning about zero. And that's much higher than normal. I mean, pre-pandemic, that number was about $3 trillion. So I think it's reasonable to expect that some of this money is going to come out and get invested. But you also might have this question: is how much of this future economic growth is already priced into the markets? After all, we have had a pretty big run-up. And how should we be investing going forward? And these are very good questions. In my quarterly commentary, I made this very analogous to a boxer in a championship fight. You know, he spends much of the match, bobbing and weaving and moving around, but he's looking for opportunity. And when he sees the opportunity, he takes advantage of the opportunity. But while he's taking advantage of the opportunity, he's not dropping his guard. He's looking out for the counterpunch as well. And if you think about it, that's kind of what we did last year in 2020 as well. When opportunity presented itself in the spring, we took advantage of it, but we didn't let our guard down in case there was a counterpunch. We stayed diversified, because diversification certainly helped as the market was falling, and certainly we all experienced a V-shaped recovery, which was very different. What Wall Street experienced and what Main Street experienced is very different. What we're waiting for is Main Street to start to catch up. There's also a question about how quickly can the vaccines get distributed. And that's, as I'm recording this video, a little bit of an issue right now, because we saw Pfizer and Moderna and other companies really do tremendous work in developing a vaccine and developing the logistics to get it out. And I had said that this was very similar to the space race in the 1960s. But right now we're seeing a little bit of a slowdown, and this delay could delay this economic recovery that I talked about before. For example, in Virginia, the goal is, at this point in time, is to vaccinate 25,000 people per day. And I should point out that at this point, in any given day, the highest amount has been 30% below that amount. But if you did the math, if they vaccinate 25,000 per day, that would take nearly a year to give everybody a first dose of the vaccination. So that's a little bit longer, I think, than Wall Street and a lot of the pundits are currently thinking about. We're also experiencing a change in administrations. There's speculation on what some of the policies will be, and indeed what can happen with Biden as president and the Democrats in control of a diminished majority in the House of Representatives and a Senate that is basically tied. And a lot of speculation revolves around inflation and taxes. Now, inflation, there's a thought with all the stimulus that's occurring that it's adding to the national debt and it's going to be inflationary. And, it is probably likely that inflation is going to go up because with the pandemic, with the economic shutdown, inflation was basically zero in 2020, maybe even a little bit below zero. So inflation was non-existent in 2020. The Fed's long-term inflation goal is about 2%. And Jay Powell, the head of the Fed, said he'd be okay if it even goes a little bit above 2% before they start to tighten monetary policy. And but there's some that think that all of this stimulus is going to be more inflationary than we've seen in quite some time. And that could happen, but I am much more sanguine about the prospects for inflation because we still have an aging demographics, although it's not quite as bad as Europe, but we have aging demographics. We have what I call the Amazon effect, the role of information technology, where we're able to compare prices at any point in time and shop for the best price very quickly. And we also have the supply lines that have caused more efficiency and have kept down prices. So I think inflation could indeed go up, but I think we're certainly not going to experience some of the inflation that occurred in the late 1970s, early 1980s, or in some other countries. As for taxes, that's also a big wild card. Joe Biden ran on a platform of increasing taxes. And as I said before, I think that taxes are probably going to go up, but probably not in 2021. I mean, maybe there'll be some things around the edges in terms of little symbolic things to raise taxes, and possibly some of the highest income people, the people who are currently in the 37% bracket, may see a little bit higher rates. But I really don't think that a Biden administration is going to crater what it will still be a very fragile economic recovery by raising taxes in 2021. Maybe 2022, but that will mainly depend, I think, on how the midterm elections go. So if you're looking at making some moves based on what might happen with taxes, I would argue that maybe we should wait to see what actually happens with taxes, because we will have some time to plan for it at that time. And we're not going to have buyer's remorse. We're not going to do things that look good to avoid potential future tax increases, but then can't be easily undone, or that there's unintended consequences. So if you have any questions on that, I would encourage you to talk to your financial strategist at Agili. And I've been very pleased to share with you our thoughts and viewpoints. If you do have any questions, feel free to contact me or to contact your financial strategist. Thanks a lot and have a great day.